like my partner, Ron Morelock. As Jessica said, our specialty is transportation law. We are by far and away, I'm sure, the largest in the U.S. We have approximately 90-some attorneys, and our headquarters are here in Indianapolis. We've got 12 other offices scattered across the country, and our focus is transportation. Been working with AIM for got to be over 20 years, and appreciate the relationship. When we first started kind of put the seminar together, we titled it Private Fleet Restructuring. But then yesterday, when I saw the attendees, it became pretty obvious we've got a pretty diverse group of carriers here. I saw for-hire motor carriers. I saw private carriers. Some of the clients I recognized, and they're a combination of private and for-hire. So we changed the title to Fleet Restructuring Issues and Objectives, not just private fleet restructurings. But in that regard, I'm going to start off and kind of give a broad perspective of fleet restructuring, some of the various objectives, some of the various models. And then Ron's going to focus more on what we call a private fleet restructuring and some of the benefits of looking at, does it make sense to restructure your private fleets? So with that, I'll get started. When I first started practicing at Scopelitis back in 1981, I would estimate that over 95% of our clients had that monolithic or single structure, where one company had all the assets, that company had all the employees. It wasn't a multi-corporate setup. Over the years, the firm's been a big advocate of having the clients take a look at that monolithic structure. Makes sense because there's various benefits that can be obtained. It doesn't fit everybody. I still do restructuring reviews where I look at it and I come up with the conclusion, the single corporate structure works well for you. I wouldn't change it. But there's a number of reasons why you may want to look at changing it, and I'm going to address kind of three common structures. I see a fair amount. If you want to change that to the next slide there. This is the monolithic structure, if you will. All the eggs in one basket, and from a liability perspective, the concern there is, okay, fleet operations are often considered high risk. You don't know when you might have that catastrophic accident. So a lot of our clients have gone to the structure on the next slide that I've got there. And this is a common one for us, and it's what I would call more of a traditional transportation for-hire motor carrier. I saw a number of those on the list. I know AIM does business with those. But the concept here is don't have all your eggs in one basket, that one entity. And here you'll see where we've split out the realty company. We've got the motor carrier, which is the high liability company in the event of an accident. Normally it have a lot of assets. We've got a logistics company as a separate legal entity because it has its own type of risk. We've got an equipment leasing company set up where the equipment, it's got value. Obviously, with an equipment leasing company where you're using a third-party vendor, that's not an issue. For example, you have AIM there, and those are their assets, not yours, so you don't have to protect them. But in looking over the people that were on the attendee list, I saw where several of you have a combination of leased equipment and still some owned equipment. So that equipment leasing company affiliate may be a good idea. What you don't want is where I've marked out that X. When you get into liability protection, the important point to remember is that brother, sister, are generally go up, but they do slow down. So if the motor carrier company gets in an accident, if it had a temporary, was not involved in the accident, it would be an asset that would be subject to a liability. The second slide here, if you want to go to the third one there for me. This is what we would say is our traditional private carrier restructuring. And here I've used a food distributor as the example. And in a monolithic structure, that food distributor would have its primary business, it'd have its private fleet, it'd have all its equipment in that top legal entity. Well, on a private fleet restructuring, and there's various benefits from this, and Ron, as I said, is going to get into the tax savings benefit. We would have a structure that's set forth in this slide. And that's where we drop the fleet operations into a separate legal entity. And if it's got equipment, we may drop the equipment into a separate equipment leasing company. Again, if you're leasing equipment from a vendor like AIM, that's not really an issue. But the objective is, at least from a liability standpoint, is to get the motor carrier operations with the high liability away from what we would call the primary business. In this case, it's food distributor, but it could have been a construction company. It could have been a steel manufacturing company, but drop the fleet down as a subsidiary. We worked on this structure for 30 plus years and helped pioneer it, frankly, and a lot of that was more sales tax driven than liability protection. But where you see liability protection for these types of companies, you're not going to have a Walmart, for example, that will have millions of insurance, and it's not going to be a liability issue so much for the really, really big private companies, but it certainly is for a smaller private company that has a fleet of 40 vehicles and it can't afford all sorts of insurance coverage. The next slide here, I'm not going to go into this too much, but I did see a couple of participants in looking at their FMCSA data who had this type of setup. It's one of these situations where you have, a lot of times it happens by a company that's acquiring companies, and it's a stock acquisition, and they end up with multiple fleets, all with their own DOT numbers. And this is where, instead of expanding into more legal entities, we consolidate a fleet from an operational standpoint. So right here, you've got 3 companies with affiliates, 3 different DOT numbers, 3 different IRP accounts, three sets of authorities, 3 safety managers, and they don't want to merge these companies into a single company, but at the same time, they'd like to get away from this duplicative administration, permits, expenses that come with that. And so what we do, and I'm not going to go into great detail on this, is set forth on the next slide. And that's where we don't merge the 3 fleets out of existence, but by what we call a master lease agreement, and that's shown by those 2 arrows there. Those 2 fleets deactivate their DOT number. You pick the best fleet that's got a good safety rating, by the way, and then those 2 fleets, by a equipment lease or fleet operator agreement, lease drivers and equipment to, in this case, fleet 2. They operate under a single U.S. DOT number, but you get to keep the 3 separate companies. You also don't have to change employment. You don't have to retitle equipment. So if you're in a situation where you've got all sorts of fleets, and you want to try to consolidate, but keep different brands, keep their separate legal entities, this is a very easy way to get that done. So I've talked about some restructurings. Going to the next slide here. If it was real easy to set up, different legal entities, and hey, we're going to get sales tax savings, we're going to get liability protection, we're going to do all these things to kind of put us in a better legal position. Well, you have to go in that type of restructuring with the mindset that it could be a tax. Usually that's a plaintiff's attorney if there's an auto accident. It could be, as Ron will get to, on the sales tax savings, a state auditor. And what they're trying to do is known legally is pierce the corporate veil. If you think of my private fleet structure there where we had a separate trucking company, our position would be if there was an accident that, well, it was a trucking company, it's not my food company. Well, a plaintiff's attorney would try to say, no, you didn't have these sorts of intercompany charges, you didn't have the corporation set up correctly, too much control by the parent company over the trucking company. So you want to go into the mindset that you got to do things right. The good news, however, is from a state law standpoint, almost all states make it very difficult to pierce the corporate veil. That is, if we set it up right, that the liabilities can't go across to another legal entity, they can't go up to another legal entity. You have to have some basic structures, procedures in place, but it's not an easy task to pierce the corporate veil under corporate law. And going to the next slide, what we're talking about here are arm's length transaction among your company affiliates. And here, and I'm not sure I've got it here, we have one more slide there with, well, I'll come back to the employment transfer, but in that arm's length transactions, what you're talking about is have intercompany agreements. Where I had the food distributor, it needs to have a transportation agreement with its for-hire motor carrier affiliate. If the food distributor is providing services such as human resources or attorney, legal services to the subsidiary motor carrier affiliate, make sure you have an administrative services agreement in place where that parent food distributor is charging the subsidiary motor carrier for those services. Now, some of the kind of best practices on a subsidiary situation or affiliate situation, you can't get away from. Almost all our companies have some sort of, they're going to have common ownership, and then some of them are going to have common officers. That just happens. But it's one of those things where you want to get as many boxes checked in your favor, so it becomes next very, very difficult for a state auditor or a plaintiff's attorney to pierce the corporate veil. Now, before I turn over to Ron, he's going to talk, as I said, about setting up a private fleet subsidiary. But going to the last slide here, good job. Employment transfers come up a lot. And employment transfers, I've given kind of, if we're at let's say the food distributor and those drivers are employed by the food distributor and we set up a separate trucking company, you don't necessarily have to transfer, you don't have to transfer employment if you don't want to achieve the sales tax exemptions that Ron's going to talk about. But if you want real liability protection, you are going to want to change the employment of the drivers from the food company distributor down to the trucking company. Because if they remain employees of the trucking company, you get some limited protection, believe it or not. Even though they're employees of the food distributor, the trucking company is leasing them from the food distributor. There's a doctrine called borrowed service that gives you some protection. But if you really want liability protection, you do need to transfer the employment of the driver to the trucking company. And I just give some of the basics there, what that involves. You want to give written notice to the employees that their employment's changing to ABC Trucking. You want to put notice get authorization to transfer US DOT files to the trucking company. And the good news here, and your safety managers love this, is you don't have to redo the DOT files, new drug testing, whether they remain employees of the food distributor and are leased to the trucking company, or they become employees of the trucking company. You can adopt those files. And then you've got your standard kind of employment application form and other documents that your HR people need to make with. But that's kind of a quick summary of some of the objectives of restructuring, some of the traditional ones. And I'll let Ron go ahead and take it over on some of the private fleet restructurings and sales tax issues.
Thank you, Andy. As Andy had mentioned, we took a look, kind of preliminary list of folks that are attending. I know there's been some others added in, but we kind of have 3 buckets here. First bucket being those that are already set up as for-hire carriers, and that's what they do, that have authorized interstate or intrastate motor carrier authority, all property for others. And I'm going to talk at length about sales tax savings primarily here, and assume that those folks are familiar with sales tax exemptions that are out there, but we'll cover some things that maybe you'll pick up on a few additional states or items that may qualify. Another bucket are folks that have an affiliated trucking company already established that has authority and transports goods for a parent company on a for-hire basis, whether that's interstate or intrastate. And I've got a few questions in place here, things that we've seen. Is that entity actually operating for hire? Does it receive compensation for those services? Or does it just hold authority and it doesn't receive compensation? There's a handful of states out there where holding certain types of interstate authority is sufficient to achieve sales tax savings. But sometimes we see where there's authority held with no compensation, and that doesn't necessarily qualify as an entity for sales tax savings. Another area we see is we've got the authority, we've got the transportation charge, but are we claiming all applicable exemptions? That's something I'll talk a little more about on down the line in the presentation here. And then a big area, which I'll touch on a little bit, but not going to go into great detail in this presentation, is do we have the appropriate structure in place? So here we've got our legal entity set up. It has the appropriate for-hire authority, motor carrier, all the regulatory things that need to be in place. But really, this is more the back office. Do we have the accounting that we need? Do we have the invoicing? Is our trucking entity paying for its transportation-related expenses, whether those are on an intercompany basis, for driver lease services, for example, or third party? Are we paying for the equipment that we're leasing? Are we paying our fuel vendors? Sometimes those steps haven't been taken. As Andy mentioned, one of our defense mechanisms is for if we take the sales tax savings, we certainly want to be able to defend it in the event of an audit. And the state taxing agencies are getting much more sophisticated over the years in terms of what they're looking for. And as auditors, those are the types of things. They may not know the motor carrier requirements as well, but they certainly understand how a company should be set up. And even if it's an affiliate, they still look to see those kind of arm's length third party type transactions, fair market value, et cetera, et cetera. The last bucket are the private motor carriers that have a fleet of vehicles used to transport their own goods, maybe obtaining sales tax exemptions in some states where a handful of states offer exemptions for vehicles over 26,000 pounds, regardless of whether they operate for hire or private, but really aren't set up and don't hold the authority or have the separate legal entity in place that's needed in order to obtain for hire motor carrier sales tax savings. So this part of my presentation is moving towards understanding the fleet structure so that we can put a structure in place to achieve sales tax savings. Normally it's going to be a private motor carrier, but as I mentioned, sometimes there's authority in hand, whether it's being used or not, we evaluate that. We also want to know the fleet operating interstate, is it operating across state lines? Even if it doesn't operate across state lines, is it transporting interstate freight that moves from a point of origin outside the state or a point of destination outside the state? And in some instances, that single state move can qualify as interstate, or is it just simply an intra-state type fleet that moves point to point in a particular state? Pick up in Cincinnati, drop off in Columbus, Ohio, for example, of a goods that's manufactured in Cincinnati, delivered in Columbus. That would be an intra-state move there. We want to take a look at the fleet. We usually ask for an equipment list here. Most of the participants will have leased equipment, of course. You may have some owned power units or trailers as well. It's important to know the type of power unit. In some instances, there's certain states that have exemptions for truck tractors only. A straight truck might not qualify. So we need to know the type of equipment. We also want to know the gross vehicle weight or the combined gross vehicle weight, not of the fleet there, but of the individual vehicle, because a number of states, that's important in determining whether or not we can set up a structure to achieve sales tax savings. Of course, we want to know your headquarters state, and then importantly, where those vehicles domiciled. Sales tax really works off, in most instances, there's some, with state taxes in general, it's always a very unique. You need to take a look at each state. There's some commonalities, but there's also variances amongst the states. So I'm going to say this generally. It's where the fleet's domicile controls the sales tax. So if you base the truck in Indiana, where I'm at, for example, and it's leased, it's the Indiana sales tax that would apply absent an exemption. And then also, kind of a little bit back to what Andy talked about, we've already got in place multiple entities, and the fleet is operating over 10,000 pounds. We need US DOT numbers. One of the advantages of the private fleet restructuring, for example, is we can consolidate, reduce some of the burden of having multiple DOT numbers. Okay, so the benefits. Here's the benefits associated with fleet restructuring. The Midwest states are generally great to have your fleet based. I've listed a number of states. I'll just touch briefly on the exemption in each one. Illinois has an exemption for interstate motor carriers. They used to require that the fleet operate more than 50% in interstate commerce across the Illinois state lines or transporting cargo moving interstate commerce. That was a disaster from an audit perspective because of the record keeping requirements. You had to keep records for each power unit, each trailer, really burdensome audits. They changed that, really freed it up, so now it's just an authorized interstate motor carrier, power units over 16,000 pounds, gross vehicle weight, and trailers will qualify for their exemption. Indiana, Ohio, Pennsylvania all have really favorable interstate and or intrastate motor carrier sales tax exemptions. The premise is each vehicle must operate more than 50% of the time transporting cargo on a for-hire basis. There's no gross vehicle weight requirement. It's just simply meeting that 50% test. Missouri has a heavy truck exemption for private or for-hire motor carriers, but then there's also kind of a gap where vehicles between 24,000 pounds and 55,000 pounds can qualify for an exemption if they operate for-hire. And Wisconsin has a pretty good sales tax exemption, but there's some federal filing requirements that have to be met by your new trucking entity that sometimes can be burdensome. But anyway, those are the kind of key states here in the Midwest, and those savings are good for owned equipment, leased equipment. Whether you aim, for example, but on a lease scenario, have to pay the tax up front in Illinois, and if there's not an exemption, put it in capitalized lease charge. it works there, or in the least flow states where the sales tax is collected on the least flow, Indiana, Ohio, Pennsylvania, etc. Transfer of driver employment is not required for the sales tax savings objective. If you want to have installation liability, as Andy mentioned, the transfer of driver employment to the truck community is an option. One of the benefits our clients like if they move from private to for-hire with a separate legal entity is that they can better analyze the transportation function or operations of their business, because now they've separated from the core business in terms of tracking the profits and loss, et cetera. If you have interest at this point, you kind of think, well, what do I need to look at to see if this makes sense? Well, we would advise each company at least do some type of an analysis, which we can help with as part of that's kind of what I've walked through here. Determine what's your sales tax savings, what can I save on equipment that I lease, what can I save on repair and replacement parts, what can I save on maintenance, et cetera. And then compare that to kind of the task and some of the minimal fees that are required to implement the strategy and manage it going forward. And one other thing I want to mention quickly is that whether you go for the installation liability objective or the sales tax objective, it's transparent and can be transparent to your customers and drivers. So tasks associated with a private fleet restructuring, you have a one-time cost to create a new trucking entity. That would be the entity that will operate the vehicles, hold the operating authority, permits, et cetera. We do that here for our clients, or clients can use their own corporate attorneys for that task. There's one-time cost for obtaining the authority so that you have that piece of paper that is necessary to operate the trucks on a for-hire basis. We need to work with accountants or in-house folks that work in that area. We'll need to have separate company books and records, including, we always recommend a bank account for your new trucking entity. We want it to be able to pay cash for transportation-related expenses, whether it's leased vehicles, different anything that's associated with the transportation function. We want our community to pay cash for that. To the extent there's intercompany charges, if we have, for example, we're leasing drivers, we're going for our sales tax objective, and these drivers are not going to transfer employment. We want those at arm's length prices and actual cash transfers on invoices. So that's your periodic intercompany invoices and payments that you would need in order to support that in the event of support that sales tax savings and that structure in the event of an audit. We want to notify all our vendors on the name, as an example. They would be familiar with you moving forward. It's one of them know that we have a new trucking entity that the entity should build for the equipment leases. Get the name changed on the account. We don't want to have things. We need to have a
numbers like that's what I hear.
Between our operating company and our trucking company. Again, it's in the event we get audited.
I was a little bit, so I get updates from Excel constantly. So they got it fixed at like.
I'm sorry.
Hey guys, can we mute our phones?
Can you please mute?
Everywhere else.
Thank you. Our new trucking entity, for example, if it's in Indiana, it needs to have a sales tax number, and it'll need to file sales tax returns, although it won't have any sales tax to report because the transportation service it provides to its an affiliate is not it's not subject to Indiana sales tax. And one other thing, I've talked a lot about just an affiliated trucking company, but many of our clients, they have opportunities for backhauling for others. And that's something that this structure would allow and also supports the sales tax savings objective, because now you would haul for third parties. You just want to make sure you fill and have that revenue collected by the trucking company and not commingle with your parent entity. You need to replacard power units, the doors on your power units to show your new trucking transportation LLC, for example. There's a couple ways you can do that. You can have your legal entity name with a new trucking company. on the door and the DOT number, or you can keep your existing company name below that with operated by your new trucking entity and have the DOT number listed. I think Andy mentioned this, but if you want to go for an installation liability objective, another task is to move the payroll over for your drivers into your new trucking entity. So steps, this kind of recaps some of the steps that are necessary for you to implement a private fleet restructuring. Our firm worked with you on your legal structure, on your motor carrier regulatory matters, as I mentioned, entity formation. There may be some new state emission requirements that can be associated with obtaining intrastate authority or possibly where you have vehicles based. There's interstate and or intrastate authority filings, DOT compliance. That's typically we can use an existing DOT number and have that moved to your new trucking company. I know Andy mentioned if you have multiple DOT numbers, we can select the one that's best positioned if there's one better position than another for that purpose. Regulatory permits, such as if there's hazardous materials or other types of permits that are required, if your trucking company would need that, those types of permits. If it's full service lease through AIM, where there's highway use tax or other permits, it makes it a little bit simpler. If you've got that in place, you wouldn't need to necessarily obtain new permits for those purposes. Insurance is usually handled for our new entity by just adding it as an additional named insured on the existing policies for your parent company, auto liability, et cetera, umbrella. That, just in our experience, that hasn't led to any additional cost. It's still the same type of risk factors under the policy. I mentioned the placarding requirements. Sometimes that can be an expense that you need to consider, but there's a couple different options for that purpose. Intercompany agreements are something that the firm would provide. I mentioned the driver lease agreement. Sometimes there's intercompany. If you have owned equipment, there can be intercompany leases of the vehicles. We have an administrative services agreement because our new trucking entity, if it just has leased drivers, it won't have employees, but it needs services such as IT, accounting, etc. And that administrative services agreement covers those types of transactions. And then to the extent there's IRP vehicles involved, we'll have a new motor carrier. We need to have that motor carrier listed on the IRP cap card as the motor carrier responsible for safety, and that comes at a minor expense. Okay. From a lease vehicle side, working with AIM, we want to get the existing lease agreements signed over to the new trucking entity. I mentioned you want to have the invoicing moved over. That's a fairly standard practice for AIM. They would have an agreement used for that purpose. We also want to have the necessary sales tax exemption forms for their claimed exemption in Indiana, Ohio, and Pennsylvania, for example. We'll work with you on that, make sure those exemption forms are in place, benefit being no longer paying sales tax on those equipment lease charges. In our experience, these are the types of folks that typically would be involved in moving from a private to a for-hire motor carrier. You want to explain to have your operations people involved, your DOT safety, risk management. I've mentioned the tax and accounting, and that's a big area. And HR, particularly if you're going to transfer any employment as a result of the restructuring. With that, we have a few minutes left. Andy?
Yeah, a couple quick hitters, Ron. You can stand up here for questions. So we'll open up for questioning, but and listen to Ron, just a few quick hitters and things I thought of you may want to keep in mind. There is an easy way, a good way to transfer over the DOT number from the existing fleet to your for-hire motor carrier. Normally your safety people like that because it brings a safety history over to the same to your new legal entity. It brings a satisfactory safety rating if that's what you have, which is the highest. You do not have to undergo a new entrant audit, so that's all good news to your safety director. Also, on insurance, your risk management people like to have this question, and the answer is good. If you do form this separate trucking company, we don't need new insurance policies for the trucking company to achieve either the liability or the sales tax exemption. They can just be added as additional named insureds on the policy. What we do want is the trucking company on these intercompany charges to pay its fair share for the, for example, auto liability coverage, because that's really what the trucking's about. There are some insurance filings that have to be made with the federal agencies and the state agencies, but that's normally not a problem. You know, there's some myths out there that over the years I think have finally gone away, but yeah, if you set up this separate trucking company, you don't have to serve other third-party shippers. You can just serve your own affiliated company. Exception to that is probably Missouri, where they want to see you hold yourself out of the common carrier, but we really haven't had, you know, difficulties with that. This is also a good structure if you're in the acquisition mode. If you acquire companies and they have fleets on an asset deal, you just fold these into your new trucking company. And I know that's been a big help for a lot of clients. Another quick hitter is I talked about employment transfer versus driver lease. Depending on when if you do change employment or want to change employment, you want to look at the timing of doing that, because if you do it, you know, mid-year, you've already paid withholding tax to the state up to a certain time period. And then if you transfer during that same time period to another company, you're paying it again. So you normally want to time, at least from a tax standpoint, that employment transfer January 1 if you've already paid the unemployment withholding tax payments. So what you can do, you can implement your restructuring even if it's like June 1st, but you just lease the drivers over for a certain period of time. You don't get the liability protection we talked about for that short period of time, but then transfer employment. Lastly, this structure works real well with full service leasing, like AIM has, because you don't have to worry about plates. You don't have to have intercompany equipment leases. It's just an assignment. Usually is how it works from the existing food distributor assigns the lease over to the trucking company. How are we?
We got plenty of time. Looks like we have a couple questions. You want me to read them to you?
Yeah, that'd
okay.
be great.
First question is, what issues exist if you are developing a new fleet outside your current company, which operates 100% IC, a dedicated trucking company that will be leasing its entire fleet onto the main trucking company, more like becoming a fleet owner?
Let's see, what is if you're developing a new fleet outside your current company? Okay, I think what we're talking about there is kind of our fleet operator concept, and I hope I get this right. We do this structure also. There's sometimes companies have employee fleets, or they have independent contractor fleets, and it's generally not a good idea if you can avoid it, even though a lot of companies have this way, is have the single motor carrier, have the employee drivers, and it's also the same company that leases on the owner-operators, because there you've got concerns about driver classification. So I think what the question is asking, if it's not this, I'll give you another reason why sometimes you have fleet restructuring, is you keep your employee drivers, if you've got employee drivers, but you want to supplement your fleet with independent contractors. Rather than leasing those independent contractors directly to the motor carrier fleet that you've got with company drivers, we form a separate affiliate. And that company is the party or the company that enters into the lease agreements with the owner-operators. So you don't have this parent company with employee drivers entering into contracts with owner operators. Rather, this affiliate does keep them separate. Then what you have is your affiliated, we want to call it fleet operator, just enters into a single lease agreement with the motor carrier that has the company drivers. The fleet operator doesn't have operating authority, doesn't have its own DOT number. It operates under the DOT number and operating authorities, can operate under the IRP account, the IFTA account of the parent. And then the parent pays the fleet operator for the services, and then the fleet operator pays the independent contractor. So this fleet operator arrangement can be really flexible, and it's a good way to separate your independent contractor drivers from the employee drivers in terms of who's the primary party they're dealing with. So that, hopefully that answers the question. But the good news there is you don't have to have this fleet operator go out and get its own DOT number or operating authority or IRP account or IFTA account. The parent, the motor carrier, operating motor carrier has it up here, and you don't have to duplicate. You do have the option, if you want to keep them totally separate, obviously, of having the owner-operator fleet have its own authority DOT number and your employee fleet. But this is a kind of a good way, a compromise, if you will.
Okay, the next question is, I would like to think that you would have to add administrative and staffing to the central entity supporting the consolidation of multiple DOT, specifically for DOT compliance issues.
Let me read that. I think you have to add administrative and staffing to the central entity supporting consolidation. I think this is talking about where my model where I had 3 legal entities, affiliates, each with their own DOT number, and then the concept was, well, let's just operate under one DOT number via these fleet operator agreements, and then this single DOT number basically covers the whole fleet. You know, that's possible, but I've often heard it just the opposite. I've heard clients say, you know, right now we have 3 safety directors because we've got different legal entities, and we prefer not to have, you know, 3 safety managers. We think we can get it out, or we have 3 people doing the IRP for each different fleet where we think one person could do that. So, you know, it kind of depends on the fleet. You got 3 fleets, each with 150 drivers. Yeah, you may have to, if you consolidate under one DOT, it may be too much work for one DOT person to handle all 450. But if they got 3, maybe it only takes 2. So it's a good question. That may be the case, but I think it kind of depends on the fleets that are involved, the size of them.
Okay, it looks like we only have one more question, and this is geared more toward S Corp versus LLC. But is there any real tax advantage for an S Corp where all income flows through the same owners of the transportation company and the operating company?
I would say normally for an S Corp, no. The S Corp is going to be disregarded for federal income tax purposes for the most part. I mean, there's still state filings for S Corps, and in some instances there could be tax associated with that. I know Indiana would tax some S Corp income, but most of it would flow through. What we typically see, though, is an advantage is to have an LLC that's disregarded for income tax purposes from the parent. So that LLC, it gives you the entity that you need for sales tax savings. It's respected for sales tax, but on an income tax side, it's ignored from the parent, so it doesn't create any new filing obligations. That's for both federal and for state. There's a handful of states that require an LLC to file and pay minimum tax, but that's they're the minority. So hopefully that addresses the question.
One other point that I was thinking of on the safety that we didn't really cover, but another issue you want to look at is under a full service lease situation. Obviously, you've got the full service lessor doing the maintenance, but if you have your own maintenance company that's involved with your trucking operations and you form a separate trucking company, you really do want to get the maintenance done by the trucking company. because a lot of times the allegation is, hey, the accident was also caused by the brakes weren't in the proper, shape, etc. So if you got maintenance and it's not a full service lease situation, and you form a separate trucking company, you do want to get the maintenance folks down at the trucking.
All right. Well, we appreciate everybody joining today's webinar. If you didn't get a chance to ask your question and you want to ask a question, feel free to reach out to Andy and or Ron. The contact information's there, or you can get their contact information through AIM. But if you guys have any more questions or you didn't understand something, feel free to reach out to us.
So appreciate the opportunity, and one good thing about this webinar, it kept me from watching the Ohio State IU game, and IU just lost. So thanks all.
Thanks, Ron and Andy.
Thank you, gentlemen.
Hey, Joe.
Hey, Jess.
Hey, Matt. I left Joe on here. Hold on. Okay, I removed him. I didn't know if Joe Gallic was like hanging on, so I didn't know if he wanted to talk to us or what, but I just booted him.
No, he probably walked away or something.
Walked away, yeah.
There was one note on here from Teresa that said, "Will you be sending the recording?" So I don't know.
Yeah, I'm asking.
Because you could send a follow up, right, on it.
Yeah, I'm gonna send a SurveyMonkey link.
If anybody has any questions or something like that.
Yeah, and I'll send a copy of the recording and then a PDF copy of the presentation.
Okay.
I'm emailing Ron and Andy now.
I think it went well.
I know Joe was texting me that one of his customers was saying they couldn't hear it and was like getting pissed.
Really?
But I had it set so like when you entered, you were automatically muted, like everybody was. So like that feedback at the beginning.
Yeah, I mean, I could hear it fine. Maybe it's because I had earbuds in. If they're trying to listen, over the computer, it might be kind of tough.
Yeah, or in the like if they were
I mean,
on
they
the
could have
phone.
Scopolitis could have had a little bit probably better microphone,
Mm-hmm.
But
I thought it went pretty well though.
overall, it went well. I think we had, I think at one point it was like 51 on there.
The highest I saw was 50, but yeah, that sounds right. I'll send out a list of the people who registered and then the people that were on, if I can, to the sales management group. Do you think I should send it to sales staff too, or just sales management?
Management.
Okay.
Yeah, it's kind of hard to tell. Is there a way you could get a log of like who was on or no?
That's what I'm going to check. I think
I was
so.
always wondered about that, how that works, how that could work. Yeah.
There has to be something.
Yeah, do you actually have to try to pick them off yourself, or is there like a listing you can grab or something?
Yeah, I started to do that, and then I was like, it was getting too difficult to match, and so I just, let's see. Well, I'll look for it. But yeah, I thought it went good.
Yeah, it looked professional. I mean, it was nice they were standing up at like a podium and stuff,
Yeah, I thought that looked really professional. Was Tom on? I don't think he was.
No.
I saw there was a Scott on. I don't know if it was Scott Fleming.
Yeah, I didn't see it. I didn't see Tom on at all.
Mm-mm. Hey, for that shred it, do you just want a copy of the schedule?
Is there any? I couldn't find. I looked in the lease master. I didn't see their name didn't pop up anywhere, unless we've already changed it.
I didn't look yet, so look. Let's see. Shit.
I just had one person that was requesting me on LinkedIn.
Oh, nice. All right, there's no lease agreement with anybody in the name that has shred anywhere in their name.
Okay, so I'll just tell them that we currently have no business with Shred-it.
Oh no, there's a schedule though.
Is there one schedule?
See, Shred It USA.
Maybe take the unit number and then search it on the lease master and see if maybe the name already got changed in the system.
Do you see the unit number on the schedule? You mean?
Yeah, because I went into the lease master and did a search for Shred-it, nothing came up. But
yeah,
if you have a schedule for Shred-it, maybe we changed the name in lease master already. Like if you could search it by unit number.
Yeah, but the unit number on this is 578.
Oh, that's all it says is 578.
Mm-hmm.
Is it just like a maintenance agreement or something?
Mm. And it expired in 2008.
Oh, okay, so it's already gone.
Yeah. It's in New York. Here, I'll send you the schedule.
I got Carrie texting me pictures of taking pictures of the screen of me and Conrad.
Nice.
And then he's got
Poor Conrad.
then I took a picture of CeeLo Green, which I tell him he's the white CeeLo Green.
How funny.
How do you stop recording this, Jess? You just hit.
Oh shit. I can edit it.